Welcome to Retiring Well, where it's our job to help you enjoy financial security in any economy. Well, we have got a terrific show lined up for you this week. We're talking about this idea of asset allocation. What is it? Why is it important? And does it apply to retirement planning at all? It's really good stuff. So sit back, relax, and enjoy today's show.
Retiring Well, providing financial security in any economy. Today is the day you can take control of your financial future and eliminate worry about your money forever. Retiring Well, featuring retirement planning specialists Robert Russell and Curvin Miller of Russell & Company in Dayton, Ohio.
Folks, I got to share something with you. The reason we do this show is because American retirees, all of you who are retired, all of you who are nearing retirement, you need to change the way you're investing during your retirement years. What you're doing, if you're following the mainstream media, if you're following CNBC, and if you're reading Kiplinger and Money Magazine or the Wall Street Journal, if you're listening to what the big Wall Street firms and the big banks are saying, if you're following mainstream media, guess what? The things you're doing for your retirement, completely off base. Because see, all of those institutions, their job is growth and accumulation. They're all about risk, and they all make money on you when you take risk, when you're focused on growth and accumulation. When it comes to your retirement planning, it's about preservation and income, and how you manage your money for preservation and income, very different than growth and accumulation. That's why we do the show, to give you that different perspective. And with that in mind, here is our topic of the week. This week, we're talking about this idea of asset allocation. And what does it mean? Is it real helpful? Does it really matter? Well, here's what I can tell you. Let's say that you're getting ready to retire, you're nearing retirement, and you go to a big Wall Street firm and you say, hey, I need, what should I do with my retirement planning? And here's what they're going to say. They're going to tell you, here's what you do. Take all your money, give it to us, and by the way, they're going to charge you on all that money, of course, and we're going to set up for you an asset allocated portfolio. I mean, doesn't that give you the just nice, warm, fuzzy feeling? An asset allocated portfolio. And what does that really mean? They're going to put some money in stocks, some money in bonds, maybe some in real estate or something. But they're going to try to build a balanced mix, and then you can just take income. And I know it sounds really good, right? But I have with me Rob Russell, Curv Miller. These are guys, they're specialists with retirement planning. They're working with people just like you every day. Guys, when you hear this, what do you have to say?
Mike, you're completely right. Wall Street's idea of true diversification is different than our definition of true diversification. They like to say true diversification and asset allocation, as it's called, is a blend of stocks and bonds, but each of them have their own risks. Part of it is because most of the times when people invest in stocks and bonds, they buy a fund or a mutual fund or something that is correlated with the markets. It can go up and down due to forces that are outside of your control. But we believe in true diversification. Rob, why don't you tell our viewers a little bit about how we approach asset allocation?
Well, you're right, Curv, that the traditional asset allocation is just a blend of stocks and bonds, but that's completely flawed and mistaken in this kind of market, in this kind of economy. So what we do is we take cues from some of the most successful pension plans and high net worth investors, and we build portfolios like a house. And we trademark that process, and it's called the fiscal house. And so when we build a portfolio, we build it with a solid foundation, and that is your protected money. Money you can't lose unless you choose. It has some principal protection built into it unless you cash it in early. So the foundation's critical. The antithesis of that is the roof, and that's your risk money. That's where Wall Street advisors love to play. If you have a portfolio of mutual funds or variable annuities or stocks and the like, you're all in the roof, because risk money is money that you can lose due to outside events beyond your control and everybody else's. Now, with the foundation and the roof, and the in-between section is the walls. And they're kind of a blend of both. They're not as safe and protected as the foundation, but they're not as risky as the roof. These are investments that are not tied or correlated to to what's going on in the risky markets. They're alternative investments that are inflation protected, and ideally they would provide some income in retirement, some cash flow. That is true diversification. That's so far beyond, exponentially farther, a quantum leap beyond asset allocation. And that's what helps our clients sleep well at night, no matter what goes on at Wall Street or in Washington.
Well, we can't control any of that. I mean, there's always going to be outside forces. I mean, imagine this house, and imagine when a tornado comes. You know, which parts of your house are most exposed to that tornado? It's the roof. That's the first place it always goes. But you got to think about it. That house, you could have the fanciest house on the block, but if it's not built upon a solid foundation, it's just going to come crumbling down around you. So it's a very simple explanation. I love this. We've been talking about this for years, Rob, and I actually remember when you had the idea of saying, look, it shouldn't be complicated.
It should be simple.
It should be very simple. And, you know, I think Wall Street does a good job of trying to complicate things. Their version of asset allocation is really a diversified roof is what it is.
Well, listen, the asset allocation is completely the wrong conversation right now. If you're in retirement or you're getting close to retirement, what we talk about here on the show and on our radio show, we talk about the retirement red zone. If you're 5 to 10 years out from retirement or you're in retirement, the conversation shouldn't be about asset allocation. It shouldn't be about how do you get the best return. It's about how do you create streams of income that you can't outlive and protect yourself from the rising cost of enjoying your life, inflation. That's really the conversation.
Now, Rob, what's a good benchmark that our viewers can use in determining how much they should have in each level of the fiscal house?
So the Morningstar study that was recently written by a couple PhDs and a CFA, they said that if you follow the traditional asset allocation model, like Mike was talking about, you have a 50-50 chance of running out of money. Not good, a coin's flip of running out of money in retirement. But we found by building the fiscal house, customizing it to you, we can get somewhere, our goal is somewhere between 5 to 6% cash flow that's inflation protected. And that's really the key, is making sure that you have enough cash flow in retirement so you don't run the risk of running out of money. And you can still, 10 years from now, enjoy doing all the things you love to do.
Yeah, and this is really the secrets of the ultra wealthy. The largest endowment funds, the largest pension funds, they take this kind of care.
The most successful ones.
The most successful take this level of care with their billions of dollars. They don't stick all their money in the stock market. They don't stick it all in, you know, in fixed accounts too. It's got to be the right blend. You have to have different accounts doing different things, accomplishing different goals. All investments have pros, cons, strings attached. It's important to understand what role they play in your life. So if you have any questions, give the number at the bottom of the screen a call. We'd love to sit down with you and actually start building your fiscal house.
That was terrific information, guys. You know, I particularly enjoyed the Morningstar report where it talked about how, you know, here these people are, even if they set up a balanced portfolio, they do everything exactly right the way Wall Street tells them to do. Half the time, they still run out of money in their retirement. You know, meanwhile, Wall Street's collecting their paycheck 100% of the time, but the clients are failing half the time. I mean, it just doesn't seem fair to me. Anyway, folks, as you're sitting there and you're watching Rob and Curve talk, I am certain that you are hearing things that you haven't heard from your current advisor. Well, the reason for that is your current advisor is probably not a retirement specialist like Rob and Curve are. And folks, I got to tell you something. You have an opportunity to talk to Rob and Curve absolutely free of charge, no obligation. All you got to do is pick up the phone. The number's on the screen. Just pick up the phone and call them. Get a second opinion. I mean, you have worked hard for your money. You've worked hard to build up that portfolio. Don't you deserve to have someone work just as hard to protect it? I believe you do. Call the number on the screen. Now, don't go away, because coming up, we're going to continue our conversation on asset allocation. Hi, my name's Michael Reese. I'm a certified financial planner who specializes in retirement planning. And for the last 18 years, I've been helping my clients enjoy financial security during their retirement years. And one of the hottest financial tools out there right now for retirement planning are annuities, but they're also the most misunderstood. And it's really no surprise why things are so confusing, because both the insurance companies and the financial media do such a poor job explaining what annuities are and when they should best be used. That's why I've created a series of videos absolutely free that you can watch in the comfort of your own home to teach you what annuities are and how they work.
Visit www.makingannuitiessimple.com today for a free video series with TV host and retirement planning strategist Michael Reese.
Hi, Michael Reese here, certified financial planner and retirement planning specialist. Got to ask you a question. Are you considering using annuities as part of your retirement planning? A lot of people are. They're really hot, but you don't want to make a mistake. You want to make sure you understand these very confusing tools. To help you better understand these tools, make the right decisions, I've created a website for you, makingannuitiessimple.com. It's absolutely free. A lot of great videos there. Make sure you check it out. Welcome back. We've been talking about asset allocation today and how Wall Street wants you to give them all your money, and they're going to charge in all their money, and they want to set up this asset allocated portfolio. And then we heard why, that's just not always the smartest thing to do. There are better ways, there are different ways to set up a portfolio to generate income in your retirement. Well, meanwhile, I know what Wall Street's going to say. They're going to come back and they're going to say, well, slow down. We can handle this income thing. We have bond ladders we can set up. We have fixed income desks, in our back offices that we can utilize. We can do this income stuff. We can protect your income. Just let us do it. All right, got to go back to the experts. Tell me, why is that not necessarily a good idea?
Well, when you talk about the common way, or I guess the traditional way to create income in retirement using laddered bond portfolios, the two things that come to my mind are GM and Detroit. I mean, the last thing I think people want to do right now is buy something that has gone up for virtually 30 years straight, because all dogs have their day. At some point, you don't want your income, your day-to-day income, to be subjected from bad financial mismanagement from whether it's a state or whether it's a company. That's really what it comes down to. It's more important to insure your income, just like you would insure your home or your car or even your life, but insure your income so you don't run out of money in retirement. And the last thing you want to do is do that with bonds, in my opinion.
Totally. I mean, you think about it, they call them fixed income, and that's a fixed rate of return. It's a fixed interest rate over the life of that bond. Well, there's really two risks to that. Is, like you mentioned, default. Think about GM in Detroit. Whoever thought that, especially people around here, we had a lot of people, the Dayton economy was very dependent upon GM. And what happens is when a company can't pay its promised benefits, ultimately there's a pecking order on who gets paid. Bondholders are, higher than stockholders, of course, but there still is risk. So there's that default risk. Detroit, kind of a product of GM's demise, suffered too. They couldn't pay their promised benefits either. And the difference between a company or a local municipality or town is they don't have a printing press like the U.S. government.
Good point.
They can raise taxes on you, but again, if they can't pay those benefits, there's risk there. That's default risk. The other risk you alluded to was what's basically referred to as interest rate risk. You said that bond prices have been on a 30-year run, and they have. It's been a 30-year bull run, because what happened is over that 30-year period since 1981, interest rates have gone down, forcing bonds high. Well, this is Act 1, Scene 1. We're starting to see this unravel a little bit in June when
Yes, we did.
Bernanke had a press conference. He had basically stated we're going to start tapering.
It's just as soon as he said that, interest rates started to move and bond prices started to fall. And depending on what types of bonds, you'd see bond movements of anywhere from 3 to 10% losses in a very short period of time.
Yes.
That is, I guess, foreshadowing to what may come in the future when interest rates rise. And I'm not saying bonds, and I don't think you are either, Curve. Bonds aren't bad. We just think right now, I mean, what's the old adage? You buy low and you sell high. Exactly. So why would we be holding something or even buying more of something that is an all-time high? We should be looking at other ways to create dependable income in retirement.
Exactly. I mean, because you don't want to, it's all about timing. And so if interest rates are very low and say the economy fixes itself through all the stimulus and the economy takes off, well, you're going to have rising interest rates. If it doesn't work, we keep spending and it has a negative effect on the dollar. You're going to have higher interest rates to pay our creditors, people who hold our bonds. So their interest rates, higher interest rates in the future are one of those things you got to be very careful on. You know, story comes to mind, and I was talking to a client in Florida, and he called me and he goes, he's a Curve. I saw in the paper today they have this municipal bond paying 4.75% interest. That's great. And I said, it is great. It sounds great. Even tax-free too. I said, it sounds really good. I said, now do me a favor, pull out that ad and look at the bottom, see if there's any fine print. And he looks and he goes, well, yeah, there is. I said, well, does it have the maturity of that bond, the maturity date? And he goes, well, it says 2035. Well, it's 2013 now. We're talking 22 years of being happy with 4.75% interest. So I hear this all the time. Curve, if I hold the bond to maturity, as long as there's no default, I'm going to get my principal back with interest.
Well, look, besides getting married, I don't want to be locked in for 22 years on anything,
right?
Just personally speaking.
Absolutely. Well, and I said, you have to be okay with that 4 3/4 for the next 22 years if you buy that.
Well, what happens between interest rates? What if they move up? That's when you get handcuffed from some type of fixed income or bond instrument like that.
Exactly. So not that it's bad, but look, you got to be proactive here. Sometimes you can look at more of an actively managed ETF that holds different bond positions. Stay short term. Make sure you have somebody who's watching them. But the single issues for long term don't make sense right now because of that interest rate risk.
I think you should be looking for strategies on how to insure your income.
Yes.
Way beyond ETFs. You don't want to be subjected to day-to-day movements in any kind of market. You want to make sure that you have your own personal pension. If you're interested in how we build that, give us a call at the bottom of the screen.
Rob, Curve, I mean, you guys are so good at explaining this stuff. I really like that idea of insuring your retirement income. I mean, it makes so much sense. When you think about it, financial security during retirement is really about the day-to-day. It's about making sure you have enough money coming in so you can do what you want to do on Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday. And having that income insured so it's coming to you no matter what the markets do. Boy, it just really creates a lot of peace of mind. And folks, I know what's happening here. You're watching the show, and Rob and Curve, I know they're talking about things that you don't hear about from your current advisor. Well, what should you do about it? Well, you know what to do about it. Pick up the phone. Call the number on the screen. You can talk to Rob and Curve absolutely free of charge, no obligation. Don't you deserve a second opinion? I mean, how hard have you worked to build your portfolio? Don't you deserve that second opinion and make sure you're making the right choices for your retirement? I believe you deserve that. All you got to do is pick up the phone and call. Now, I don't want you going anywhere because coming up is our question of the week.
You're on the back nine heading for the clubhouse. Your dreams of spending time with family and enjoying retirement are just within reach. What happens if you end up in the rough? In these uncertain times, it's crucial to be prepared with sound advice. Russell & Company is one of the area's premier retirement planning specialists. For a complimentary consultation, call 1-800-392-4378. Russell & Company, helping you create a winning strategy.
Hi, Michael Reese here, and you know what I found is in that critical period, the 5 years before retirement, all the way to the 5 years after retirement, in that 10-year period, I find that over and over again, Americans are making mistakes with their financial planning that, quite frankly, are easily avoided, and it really almost breaks my heart because if you make little mistakes in this period of time, you can have huge consequences. So in order to help you not make those mistakes, I've put together a simple website with some free videos from me to you to help you be smart about your planning. The website is called 3mistakes.com. It's the number 3 spelled out, THREE, 3mistakes.com. Why don't you go there today? Welcome back. It's time for our question of the week.
This week's question comes from Henry from Kettering, Ohio. I'm 62 years old and looking to take Social Security. I'm still working, and someone told me there are penalties if I make too much money. Is this true? And if so, what are the penalties?
What a terrific question. There's so many unknowns about how you should take Social Security, because there's literally thousands of different ways and options to take Social Security income when you hit retirement age. Now, Curve, why don't you answer the question directly and how that kind of works? How do people kind of get penalized by taking Social Security maybe too early?
Right. One of the ways you get penalized by taking Social Security too early, or at 62, or sometime before your full retirement age, is if you're still working. Okay, so if you have wages in excess of $15,120 and you decide to also draw Social Security, for every $2 in earnings you have over that $15,000, you're going to give $1 back of your Social Security benefit. That's just before you're in full retirement age. Now, in the year that you turn your full retirement age, you can actually do it, but there's still a penalty. If you have income over $40,000, for every $3 in wages over $40,000, you give $1 back. So it's not as bad, but you're still going to be giving that benefit back. That's a hard thing. People don't know whether to take Social Security, wait or take it. And sometimes I find people even feel guilty taking it. Mm-hmm. But you can't forget something. You paid into that out of your paycheck every single year. You paid into that. It's your money. So you got to maximize it.
And when you talk about full retirement age, so if you've reached full retirement age, which basically means if you were born 1960 or later, your full retirement age is going to be age 67. So if you're 67 years old, or when you hit 67, that's your full retirement age. What he just said is a moot point. It does not apply to you.
That's right.
But as long as you're under your full retirement age, you take Social Security early, or what they consider to be early, and you're still making wages above $15,000. For every $2 you make above that, you're giving $1 back to the government.
And it may make sense to wait. Mm-hmm. So there's a lot of questions about Social Security. Mm-hmm. This is a question we get all the time. Do we take it now or do we wait? So there's a lot of things you have to take into account.
Yeah, with the thousands of options and ways to maximize your Social Security income, it might be helpful if you had a handy-dandy guide to help you through it. And what we have here at Russell & Company is the what, when, who, and how, the Social Security's decision guide. It may help you. So next time you're in the office, make sure you ask for one of these. Great question.
Do you want your question answered on Retiring Well? Send us an email to question@retiringwell.tv.
All right, I don't know why I'm thinking about this, but I got to ask you. Do you remember your first calculator? Remember when those first calculators came out? I remember. I was in high school when the first calculators came out. Remember those things? They had the red LED lights. We were so excited because you could do addition, subtraction, multiplication, and best of all, division. Oh my goodness, I don't know about you. I hated doing those long division. Remember those long division calculations? What a pain. Calculators came around and boom, took care of all of it for us. Meanwhile, at the same time, computers. Remember the computers? They would fill entire rooms. And remember punch cards? Remember those days? You had to put a punch card in the stupid thing, then a punch card would come out. What a pain. I can't believe anybody used them. But, right, they represented progress. And it's funny, 20 years ago, now just think about this. 20 years ago, just 20 years ago, there was no internet, no Google. So if you want, nowadays, if you want to find something out, you just Google it. I couldn't do that 20 years ago. There's no internet, no Google, cell phones. Remember the cell phone? right in my pocket here. I'm going to pull this out. This is my iPhone right here, right? This is that's it. That's a cell phone. By the way, more powerful than a whole building of computers, right? Back 20 years ago or whatever. But cell phones came in bags. Remember that? They came in these big bags. They were terrible. They were huge. Almost, I don't know how anybody used them, but that's what they were. In fact, and GPS. Oh my goodness, GPS was for the military, right? They're the only ones that had it. So what's my point? My point is this. Today, we are talking about asset allocation. We're really talking about retirement income in different ways to generate retirement income. And I got to tell you, this drives me crazy. And here's what drives me crazy. What drives me crazy is this. The world has changed. In the past 20 years, we've gone from no internet to internet's everywhere, no Google to Google is everywhere, cell phones and bags to iPhones. The world has changed. But Wall Street has not. They haven't changed at all. They're telling you, when it comes to building a portfolio for your retirement, they're telling you, you need to do this asset allocated idea. You need to put a balanced portfolio together. And you know what? What they're telling you today, it's the exact same message that they were telling you 20 years ago. When my parents retired at the end of the 90s, my dad retires 1999. And when he retired, I put together one of these balanced portfolios for him, right? That was just absolutely perfect as far as Wall Street was concerned. And you know what happened? I'll tell you what happened. A couple of planes went in the World Trade Center, and the next thing you know, my dad's portfolio values are plummeting. He lost half of his money within a couple years, right? I did everything right. He's losing half his money. You can't tell me that that's a good way to do things. And then what happens? 2008 rolls around, and for people that were just kept doing the same thing, it happened again. Okay, don't we learn from our past mistakes? Isn't that what we're supposed to do? Wall Street doesn't. You know why? Because they don't get hurt. When portfolio values fall, they don't get hurt. They don't pay the penalty. Nobody went to my parents and said, from Wall Street said, oh, gee, we're sorry we lost half your money. Here, let us pay it back to you. It's just how it goes. That's not good enough. And what really irritates me is that for years now, there are better ways to protect your retirement income. We use them, right? The advisors use them, and we've been using them for years. We protected our clients in 2008. Wall Street didn't. Yet everyone seems to ignore that it's possible to protect yourself. Folks, this is why you need to do things differently in your retirement years. Pick up the phone, call the number, talk to an advisor, learn a better way. You deserve it. And that, my friends, is our show for the week. Have a great weekend.